Welcome, investors, to Investment Stories, where we dissect the forces shaping your financial future. Today, we're diving deep into the turbulent waters of Wall Street, where the tides are being turned by the resurgence of tariffs. Specifically, the market is grappling with the implications of policies championed by a figure whose name resonates powerfully in the American economic landscape. Just recently, the market witnessed a period of significant volatility directly linked to announcements surrounding tariffs. We saw major indices react sharply, a clear indicator of the weight these policies carry. It's not just abstract economic theory, it's real-world impact on stock prices, on corporate earnings, and ultimately on your investment portfolios. Consider the immediate aftermath of the latest tariff proposals. The Dow Jones Industrial Average, a bellwether of American industry, experienced a notable drop. The S&P 500, representing a broader spectrum of the market, also saw significant declines. Even the tech-heavy Nasdaq, often seen as less directly impacted by traditional trade, wasn't immune to the negative sentiment. These weren't minor fluctuations, they were substantial movements reflecting deep-seated concerns among investors. What's driving this unease? It boils down to the fundamental unpredictability that tariffs inject into the economic equation. When the cost of imported goods rises due to tariffs, American businesses face a difficult choice: absorb those higher costs, potentially squeezing their profit margins, or pass those costs on to consumers, risking a decrease in demand for their products. Neither scenario is particularly appealing for corporate bottom lines, and Wall Street is acutely aware of this. The complexity is further amplified by the global nature of supply chains. Many American companies rely on components and materials sourced from overseas. Tariffs can disrupt these intricate networks, leading to delays, increased production costs, and ultimately reduced competitiveness. This isn't just about goods coming into the U.S., it's about the ability of American companies to operate efficiently and effectively in a global marketplace. We're also seeing a divergence in perspectives. Some analysts believe that these tariffs are a negotiating tactic, a way to pressure trading partners into more favorable agreements. They might argue that the current volatility is a short-term reaction, a necessary bump in the road towards a more balanced trade landscape. However, others are far more pessimistic, warning of potential trade wars, retaliatory tariffs from other nations, and a significant drag on global economic growth. This lack of consensus among the experts only adds to the uncertainty swirling around the market. Adding another layer of complexity is the stance of the Federal Reserve. Recent statements from the Fed chair have indicated a concern that tariffs could lead to increased inflation and potentially slower economic growth. This acknowledgement from the central bank, the very institution tasked with maintaining price stability and full employment, has further spooked investors. The fear is that the actions taken on trade could counteract the Fed's efforts to manage the economy, creating a challenging environment for businesses and consumers alike. It's crucial for American investors to understand that these aren't isolated events. The implementation and even the threat of tariffs have far-reaching consequences that extend beyond the price tags of imported goods. They impact corporate investment decisions, hiring practices, and overall business confidence. When companies are unsure about the future costs of their inputs or their ability to access international markets, they become more hesitant to invest and expand, which can have a ripple effect throughout the entire economy. Consider specific sectors. Industries that heavily rely on imported materials, such as manufacturing and construction, are particularly vulnerable. Retailers who sell imported goods may also face significant challenges as they navigate higher costs and potentially less price-sensitive consumers. Even technology companies, despite their global reach, can be affected by tariffs on components and the potential for reduced international sales if trade tensions escalate. The automotive industry, for example, a cornerstone of the American economy, operates with highly integrated global supply chains. Tariffs on imported auto parts or vehicles could significantly increase production costs for domestic manufacturers and the prices consumers pay for cars and trucks. This could lead to decreased sales, impacting jobs and investment in this crucial sector. Similarly, the agricultural sector, while often seen as export-oriented, can also be affected by tariffs. Retaliatory tariffs from other countries on American agricultural products can harm farmers and reduce export opportunities, impacting farm incomes and the overall rural economy. The impact on consumers is also a major concern. Higher prices for imported goods, whether directly through tariffs or indirectly through businesses passing on their increased costs, can erode purchasing power and lead to a lower standard of living. Everyday items, from electronics to clothing to food, could become more expensive, squeezing household budgets across the country. Therefore, as we delve deeper into this unfolding story, remember that the warnings from Wall Street strategists are not just abstract financial jargon. They represent a genuine concern about the potential for these tariff policies to disrupt the delicate balance of the American economy and negatively impact the investments that millions of Americans rely on for their future. The U.S. has a long and complex history with tariffs dating back to the very foundation of the nation. In the early days, tariffs were a primary source of revenue for the federal government. However, as the nation industrialized, tariffs became more closely linked to protectionist policies aimed at shielding domestic industries from foreign competition. The debates surrounding these policies have often been fierce, pitting the interests of manufacturers against those of consumers and agricultural exporters. One of the most significant periods of high tariffs in American history was during the early 20th century, culminating in the Smoot-Hawley Tariff Act of 1930. Enacted during the Great Depression, this act raised tariffs on thousands of imported goods. The intention was to protect American jobs and industries. However, the reality was far more devastating. Other countries retaliated with their own tariffs, leading to a sharp decline in international trade. Many economists now believe that Smoot-Hawley exacerbated and prolonged the Great Depression, demonstrating the severe negative consequences that protectionist policies can have on a global scale. While the economic landscape of the 21st century is vastly different from that of the 1930s, the lessons of Smoot-Hawley remain relevant. They serve as a stark reminder of the interconnectedness of the global economy and the dangers of isolating oneself through protectionist measures. The global supply chains we discussed earlier are a testament to this interconnectedness. Disrupting these chains through tariffs can have far-reaching and unintended consequences. More recently, we've witnessed the impact of tariffs imposed in the past few years. While the scale and scope differed from the Smoot-Hawley era, the effects were still significant. We saw American businesses grapple with increased costs for imported materials, leading some to raise prices for consumers or absorb the losses, impacting their profitability. Certain sectors like steel and aluminum experienced price fluctuations and shifts in global trade patterns. The impact on American agriculture during these recent tariff periods also provides a cautionary tale. Retaliatory tariffs from key trading partners targeted agricultural exports, leading to decreased demand and financial hardship for many American farmers. Government subsidies were often implemented to mitigate these effects, but this highlights the potential for tariffs to necessitate costly interventions and distort market dynamics. Looking back at these historical episodes, a pattern emerges. While tariffs might offer short-term protection to specific domestic industries, they often come at a broader economic cost. They can lead to higher prices for consumers, reduced competitiveness for businesses that rely on imported inputs, and retaliatory measures that harm export-oriented sectors. The complexity of the modern global economy with its intricate supply chains and interconnected markets only amplifies these risks. Consider the auto industry again. Modern vehicles are assembled using parts sourced from numerous countries. Tariffs on steel, aluminum, semiconductors, or other components can significantly increase the cost of manufacturing a car in the United States, potentially making American-made vehicles less competitive both domestically and internationally. This could lead to job losses in the manufacturing sector, the very sector that tariffs are often intended to protect. Similarly, the technology sector relies heavily on global supply chains for components used in smartphones, computers, and other electronic devices. Tariffs on these imports would likely lead to higher prices for consumers and could hinder innovation by increasing the cost of research and development. In a rapidly evolving industry like technology, maintaining access to global markets and supply chains is crucial for competitiveness. The agricultural sector's experience with retaliatory tariffs is particularly instructive. When the U.S. imposes tariffs on goods from another country, that country often responds by targeting American exports, and agricultural products are frequently caught in the crossfire. This can lead to a loss of key export markets for American farmers, resulting in lower prices for their goods and significant financial strain. Therefore, as we consider the warnings from Wall Street strategists today, it's essential to view them through the lens of history. The potential for tariffs to create economic uncertainty, disrupt trade flows, and trigger retaliatory measures is not just theoretical, it's a lesson learned repeatedly throughout American economic history. While the specific circumstances of each era differ, the fundamental risks associated with protectionist trade policies remain. The strategists on Wall Street are keenly aware of these historical precedents and the potential for history to repeat itself. Their warnings reflect a deep understanding of the interconnectedness of the global economy and the potential for tariffs to unravel the complex web of international trade that underpins much of American economic prosperity. They see the potential for these policies to not only impact corporate earnings and stock prices but also to have broader macroeconomic consequences that could affect the entire nation. One of the most pressing concerns among Wall Street strategists is the potential for tariffs to fuel inflation. As we discussed earlier, tariffs increase the cost of imported goods, forcing businesses to either absorb these costs or pass them on to consumers. If businesses choose the latter, we could see a rise in the prices of a wide range of goods, from raw materials and components to finished products. This inflationary pressure could erode the purchasing power of American consumers and potentially lead to a slowdown in economic growth. The Federal Reserve, as we touched on earlier, is also closely monitoring the potential inflationary effects of tariffs. Their mandate is to maintain price stability, and a sustained increase in inflation could force them to raise interest rates. Higher interest rates, while intended to curb inflation, can also slow down economic activity by making borrowing more expensive for businesses and consumers. This creates a delicate balancing act for the Fed, and the added uncertainty of tariffs complicates their policy decisions. Beyond inflation, Wall Street strategists are also concerned about the potential impact of tariffs on overall economic growth. When businesses face increased costs and uncertainty, they are less likely to invest in expansion, hire new workers, or launch new products. This can lead to a slowdown in economic activity, potentially impacting GDP growth and job creation. The fear is that tariffs could act as a drag on the economy, offsetting the positive effects of other economic policies. The impact on specific sectors of the American economy is also a significant concern. As we've discussed, industries that rely heavily on imported materials, such as manufacturing and construction, are particularly vulnerable. The automotive industry, with its complex global supply chains, could face significant challenges. The technology sector, despite its global reach, could also be affected by tariffs on components and the potential for reduced international sales. Consider the ramifications for the manufacturing sector. If tariffs on imported steel and aluminum lead to higher prices for these materials, American manufacturers will face increased production costs. This could make them less competitive in both domestic and international markets, potentially leading to job losses and reduced investment in the sector. The ripple effects could extend to related industries, such as transportation and logistics. The construction sector, which relies on a variety of imported materials, could also be significantly impacted. Higher prices for steel, lumber, and other building materials could lead to increased construction costs, making housing and infrastructure projects more expensive. This could dampen demand for new construction and potentially slow down economic growth in this sector. The retail sector, which sells a wide range of imported goods, could also face challenges. Retailers may be forced to raise prices to offset the increased costs of tariffs, potentially leading to reduced consumer demand. This could impact sales and profits for retailers, particularly those that cater to price-sensitive consumers. The agricultural sector, as we've noted, is particularly vulnerable to retaliatory tariffs. When the U.S. imposes tariffs on goods from another country, that country often responds by targeting American agricultural exports. This can lead to a loss of key export markets for American farmers, resulting in lower prices for their goods and significant financial strain. The impact on rural economies, which rely heavily on agriculture, could be significant. The technology sector, while often seen as less directly impacted by traditional trade, is also vulnerable. Many technology companies rely on global supply chains for components used in smartphones, computers, and other electronic devices. Tariffs on these imports could lead to higher prices for consumers and hinder innovation by increasing the cost of research and development. In a rapidly evolving industry like technology, maintaining access to global markets and supply chains is crucial for competitiveness. Wall Street strategists are also concerned about the potential for tariffs to create uncertainty in the financial markets. Uncertainty can lead to increased volatility, making it difficult for investors to make informed decisions. This volatility can also impact corporate investment decisions as businesses become more hesitant to invest in new projects when the future is uncertain. Furthermore, the potential for trade disputes to escalate into full-blown trade wars is a significant concern. Retaliatory tariffs from other countries could lead to a downward spiral of protectionism, harming global trade and economic growth. This scenario is particularly worrisome for American businesses that rely on international markets for their sales and profits. One area that often gains attention during periods of economic uncertainty is the realm of defensive stocks. These are typically companies that provide essential goods and services, demand for which tends to remain relatively stable regardless of the broader economic climate. Sectors like consumer staples, think food, beverages, and household products, healthcare, and utilities often fall into this category. These companies tend to have consistent earnings and dividend payouts, which can provide a degree of stability to a portfolio during turbulent times. Consider the consumer staples sector. People need to eat, drink, and maintain their households regardless of whether there's a trade dispute or not. Companies that produce these essential goods often have strong brand loyalty and pricing power, which can help them weather economic storms. Similarly, healthcare is a necessity and demand for healthcare services and products tends to be relatively inelastic. Utility companies provide essential services like electricity and water, making them less susceptible to economic downturns. Another potential strategy involves focusing on companies with strong domestic operations and less reliance on international supply chains or exports. If tariffs disrupt global trade, companies that primarily operate within the U.S. might be better positioned to maintain their profitability. This doesn't mean completely avoiding international exposure, but rather prioritizing companies with a significant domestic revenue base. However, it's crucial to remember that even domestically focused companies can be indirectly affected by tariffs. For example, if tariffs lead to higher inflation, even domestic retailers will face increased costs for some of their goods. Therefore, a thorough analysis of a company's supply chain and pricing power is still essential. Investing in companies with strong pricing power is another strategy to consider. Companies that have the ability to raise prices without significantly impacting demand for their products or services may be better equipped to absorb or pass on the increased costs associated with tariffs. This pricing power often comes from strong brands, unique products, or limited competition within their respective markets. Another avenue to explore is the potential for increased investment in certain domestic industries that might benefit from reduced foreign competition due to tariffs. For example, if tariffs are imposed on imported goods, domestic producers of those goods might see an increase in demand. However, it's important to carefully analyze whether these domestic industries have the capacity to meet increased demand and whether they rely on imported components themselves. It's also worth considering the potential impact of tariffs on the technology sector. While some areas of the tech industry rely on global supply chains, others, particularly those focused on software and digital services, might be less directly affected by tariffs on physical goods. Companies with strong intellectual property and recurring revenue models could potentially offer some resilience. However, even within the technology sector, it's crucial to differentiate. Companies that manufacture hardware and rely on imported components could face significant challenges. Conversely, companies focused on software, cloud computing, and cybersecurity might be less directly impacted, although they could still be affected by broader economic slowdowns. Diversification remains a cornerstone of sound investment strategy, especially during periods of uncertainty. Spreading your investments across different asset classes, sectors, and geographies can help to mitigate risk. This doesn't eliminate the potential for losses, but it can help to cushion the impact of negative events in any single area of your portfolio. For example, in addition to stocks, consider allocating a portion of your portfolio to bonds, which can act as a safe haven during volatile periods. Different types of bonds, such as government bonds or high-quality corporate bonds, can offer varying levels of risk and return. Consulting with a financial advisor to determine the appropriate asset allocation for your individual circumstances is crucial. Furthermore, staying informed and adapting your strategy as the situation evolves is essential. The landscape of tariffs and trade relationships can change rapidly, and it's important to monitor these developments and understand their potential implications for your investments. This might involve adjusting your portfolio allocations or reevaluating your investment thesis for certain companies or sectors. It's also crucial to avoid making impulsive decisions based on short-term market fluctuations. Tariffs can create significant volatility, but reacting emotionally to every market swing can be detrimental to your long-term investment goals. Maintaining a long-term perspective and focusing on the fundamental strengths of your investments is often the most prudent approach. Finally, consider seeking professional financial advice. A qualified financial advisor can help you assess your risk tolerance, understand the potential implications of tariffs for your portfolio, and develop a personalized investment strategy tailored to your specific needs and goals. They can provide valuable guidance in navigating these uncertain times and help you make informed decisions about your financial future. The central theme of our discussion has been uncertainty. The imposition and even the threat of tariffs inject a significant degree of unpredictability into the economic outlook. This uncertainty stems from several factors: the unknown extent and duration of these policies, the potential for retaliatory measures from other nations, and the difficulty in predicting the ultimate impact on corporate earnings, inflation, and overall economic growth. Wall Street strategists are understandably cautious. Their warnings reflect a deep understanding of the interconnectedness of the global economy and the potential for tariffs to disrupt established trade flows and supply chains. The historical lessons of protectionist trade policies serve as a stark reminder of the potential for unintended negative consequences. For American investors, navigating this environment requires a thoughtful and disciplined approach. Knee-jerk reactions to market volatility should be avoided. Instead, focus on understanding the fundamental drivers of your investments and consider strategies that can help mitigate risk in an uncertain climate. Defensive sectors, companies with strong domestic operations, and those with pricing power may offer some relative stability. Diversification across asset classes and sectors remains a crucial risk management tool. Staying informed about developments in trade policy and their potential implications is also essential. However, remember to rely on credible news sources and avoid being swayed by short-term market noise. The role of the Federal Reserve in this context is also critical. Their response to potential inflationary pressures arising from tariffs will have significant implications for interest rates and economic growth. Monitoring the Fed's pronouncements and actions will be crucial for understanding the broader economic landscape. Ultimately, the long-term impact of these tariff policies remains to be seen. The global economic landscape is constantly evolving, and trade relationships are subject to change. Investors need to be prepared for potential shifts and be willing to adapt their strategies as new information emerges. It's also important to remember that economic forecasts are inherently uncertain. While Wall Street strategists offer valuable insights based on their expertise and analysis, their predictions are not guarantees. Maintaining a long-term perspective and focusing on your individual financial goals remains paramount. In conclusion, the resurgence of tariffs has undoubtedly created a layer of uncertainty for Wall Street and American investors. By understanding the historical context, the specific concerns being raised, and potential strategies for navigating this environment, you can make more informed decisions about your investment portfolio. Remember to stay informed, remain disciplined, and consider seeking professional financial advice to help you navigate these evolving market conditions.